All right. So our last stop through the labyrinth here, the Greeks. This is the Minotaur. This is what we're going to try to tackle here today. I feel like there's not a lot of information about the Greeks out there. So what we've been talking about so far today is building up to the Greeks. I put the definition up there. They're quantities representing the sensitivity of option pricing as it relates to the underlying futures price. So how many of you trade options and say things like, I hope, or it's probable, or it's likely, or not likely? That's what the Greeks are trying to help you get away from. Trying to put quantities on those terms so you can use that knowledge to make better decisions. Whether you're in a position, or I'm sorry, whether you're looking to get into a position and execute that trade, or if you're in a position and the underlying changed. So you can look at these Greeks to see how your option is going to change. So there are 5 Greeks we're going to discuss here today. And I'm just scratching the surface here. We can go over each Greek in length. And Jim, I'd be happy to come on the mornings with Jim, and we can go over one at a time. We can look at charts and how you would use each of these Greeks. I think they're very important to understand. If you want to be a super option trader, you should understand how to use Greeks. So let's start with our first one here. Theoretical value. This is probably the simplest and one that you probably have already used. We've talked about it today already with some of our trades. The theoretical value is the price one would expect to pay in order just to break even in the long run. So theoretical value is based on probability. And this is the definition I use for clients. It's the fair market value. So let's go back to our option board here, and let's take a look. Earlier we were discussing the 98 even call. Take a look at the theoretical value. 152. That's the fair market value. Again, this is one of the first things that I'll quote to a client. This is the fair market value for the 98 even call. Then what we can do is take a look at the bid and the ask. There's a bid of 147 and an offer of 150. What does that tell you? This particular strike is trading below its theoretical value, below its fair market value. So if you're an option buyer and your other technicals and your chart formation set up, here's an option that you want to get in on, because you can get on it below fair market value. Our next one here is implied volatility. I don't have this on our option board, because really, when you're looking at applied volatility, you want to compare it with things such as historical volatility. If applied volatility is just on your quote board here, you can't really do too much with it unless you compare it to other Greeks. But your implied volatility is the estimated volatility of a commodity's price. And why is this important? Because as option traders, we're concerned with 2 things: direction and speed. Direction is just like the underlying futures contract. For bullish, we want the market to go up. For bearish, we want the market to go down. Same with, we talked about calls and puts earlier. For calls, we're bullish. If we were holding puts, we're bearish. Easy, right? The speed part is very difficult when it comes to option trading. Why? Because they're decaying assets. We looked at the chart of time value. As we get closer to expiration, they start to lose value. So you want to know how slow or fast the market's going to trade. That's very important as an option trader, is the speed. We looked at some strategies that we can use if we're uncertain of the speed. So the implied volatility, it's common for traders, like floor traders. They'll say that this is the actual premium level, your implied volatility. We looked at factors that make up the time value and intrinsic value, the expiration dates. We looked at the strike prices, interest rates. Those are all set for the most part. Remember I mentioned the volatility was one of the important keys that we needed to know as part of the factors. That's your implied volatility. It can help you determine if a contract is overpriced or undervalued. So it's overpriced, you want to be an option seller. If it's undervalued, you want to be an option buyer. So we can use one of our strategies. We can determine the implied volatility. We can use one of our strategies that will help us get into a position where it's overpriced or if the market is undervalued.
This material is conveyed as a solicitation for entering into a derivatives transaction. This material has been prepared by a Daniels Trading broker who provides research market commentary and trade recommendations as part of his or her solicitation for accounts and solicitation for trades. Daniels Trading, its principals, brokers, and employees may trade in derivatives for their own accounts or for the accounts of others. Due to various factors such as risk tolerance, margin requirements, trading objectives, short-term versus long-term strategies, technical versus fundamental market analysis, and other factors, such trading may result in the initiation or liquidation of positions that are different from or contrary to the opinions and recommendations contained therein. Past performance is not necessarily indicative of future performance. The risk of loss in trading futures contracts or commodity options can be substantial, and therefore investors should understand the risks involved in taking leveraged positions and must assume responsibility for the risks associated with such investments and for their results. You should carefully consider whether such trading is suitable for you in light of your circumstances and financial resources. You should read the risk disclosure accessed at www.danielstrading.com. Daniels Trading is not affiliated with, nor does it endorse any trading system, newsletter, or similar service. Daniels Trading does not guarantee or verify any performance claims made by such systems or services. When investing in the purchasing of options, you may lose all of the money you invested. When selling options, you may lose more than the funds you invested.